Welcome to the Monday Futures Market Outlook for January 24th, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try out the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. When we've crossed above that 80-week moving average in 2009, it bullishly stayed above there. And when we rolled up from the 2010 correction during the summer, we were targeting a move up towards the 1300 to 1350 area. That's still something that we think can be achieved over the next 3 to 4 months. When we take a closer look at the S&P 500 using that E-mini futures contract, we more or less were looking for a rally that would find overhead resistance and subsequently correct. On Wednesday, we had a corrective pattern on the downside that began. We're at a critical stage over the next day or two today on Monday and Tuesday because as the market here, if it fails to actually rally or follow through on that reversal candle down, then we should see a big sell day come in that will break this market down towards the 1260 area on the downside. A deeper correction should see us profit take all the way down to even as low as the 1220 area on the downside. We do not believe that this is something that will amount into a crash, so more than likely any sell cycle like that will lead to a buying opportunity for a rally into the second quarter. Just to review our key points, we remain intermediate bullish on the markets for the first half of the year. We continue to see momentum loss and a lack of market breadth. This rally is almost purely running on the large cap stocks such as General Electric, IBM, Exxon, and so on that are actually driving this market higher. You can see the divergences as the NASDAQ and the S&P have already weakened while the Dow has actually pushed to new highs. That divergence will only last so long. We are continue to be concerned about profit-taking cycle through these earnings season, and this week is a very big earnings week. So we're going to see whether or not a few drivers create that profit-taking cycle. But beyond any multi-week profit-taking cycles, we do believe this rally can last deep into the second quarter of the year. So we're not bearish at any in the bigger picture just yet. Next here, I want to take a look at the NASDAQ 100 using that E-mini futures contract. We set an upside target around this 2300 to 2360. That reversal candle came in exactly where we anticipated it, right in our target zone. Really at this juncture, with this reversal, you can see how strong it is. There really is distribution going on in the broader markets, including the NASDAQ. We could see a little bit of a snapback attempt here somewhere, but in the bigger picture, we see this move potentially heading right back down to the 2200 area on the downside. But again, that will probably amount to being a buying opportunity. Next year, I want to take a look at the U.S. dollar index futures, and this here at this juncture is a very interesting chart. We had a technical breakdown below the 79 level. More or less, we were saying that any short-term break that can even just on a very temporary basis test the 78, 78.50 area, so long as it reverses back from that area on the upside, then that would be a false breakdown. So this is really the make it or break it moment for the U.S. dollar index. Is at the edge of a cliff here, and if it gets one more push, particularly with a very big thrust higher in the euro, then we could see not only a double bottom retest, but even a move that could drop down to even the 75 or 74 levels on the downside. So really at this stage, it becomes critical to see whether or not the U.S. dollar bulls can actually dig in and find supports. A lot of it will be based on whether or not that euro short squeeze continues to happen or not. If the euro tops out here, then we could see this be the place where that U.S. dollar index finds that support. Next year, I want to take a look at the gold futures market. We drew in that flagging formation last week, and we were talking about how critical that 1360 level was on the downside. That when broken, we would see a move accelerate potentially down towards the 1330 area on the downside. We more or less had a move that came about $5 away from that target zone. We're getting a little bit of a reversal candle. The one thing we're looking here is whether this entire gold consolidation here ends up being just one flagging formation that can bullish bullishly turn up. We still think that there's further room for gold to correct, particularly if there's a strong US dollar rally, but we're going to watch and see how far this goes. So long as it holds below 1360, then we'll still look for further weakness, which could even off of these tops work its way down even as deep as 1260 on the downside. Next here, I want to take a look at the crude oil futures contracts. There was numerous attempts by crude oil to break above that 92, 92.50 kind of area along where all those tops are, and it continues to reject there. This is actually going to play a lot on whether or not we do get that breakdown in the dollar index. If we see of any strong weakness come in the US dollar, this crude oil could find the base here and actually make that move up toward the 94, 96 zone on the upside, where there's a number of measured moves. But if crude really tops out here and has any break below that 87, 88 zone, that would mark off some form of a double top, which could accelerate and even see a $10 top to bottom drop on crude. Finally, I want to take a look at that 10-year Treasury note, and more or less we've been developing this flagging formation. We were looking for either A, to reject off this 121.5 to 122 area and start selling off downwards like this, or we were expecting that there could have been one more push higher before it rolled out. One way or another, we continue to remain bearish on the 10-year Treasury notes. At some stage by the second quarter of the year, we anticipate some bottoming formations to start developing on the Treasury notes, but more than likely there's one more leg lower first before we start looking for a formation like that. Any technical breaks right now that go any lower than this, let's even say the 119.5 area, would really start to open the window for acceleration. Any break to a lower low would really kind of throw some fuel on the fire, as it would probably head right down towards the 117 to 115 area on the downside. That was your Monday Futures Market Outlook. Thank you for joining me.